In Canberra,
Ottawa.
in Canada, yes, in Ottawa. But now talking about central banks' effectiveness and looking to the US central bank in particular, let's bring in fund manager Morphic Asset Management's Geoff Wood. Geoff Wood, thanks for joining us.
Hi, Helen.
Now, the Fed last week lowered their projections of hikes from 4 to 2 this year. How did you read that? Essentially a change of position.
Yeah, it was a relatively big move. They've not moved the dots by that much in the last 12 months, so it's quite a signal to the market. This is a case where the Fed have moved to the bond market. So the bond market was pricing and still is around 1.5 hikes over the next 12 months. And so the Fed were quite out of kilter there. But the market took a lot of comfort in the fact that the Fed have said, OK, we agree, you're right on this one.
So what about this theme coming from a number of central bank chiefs, that monetary policy can't do it all? They just cannot keep sustaining economic growth in economies.
Yeah, I think they're starting to get a little bit concerned that they're running out of ammunition. They've seen the reaction in markets, particularly bank stocks, to negative interest rates in Japan and Europe, and really they're looking over at the government and wondering possibly should there be more fiscal expansion to help do some of the legwork.
Yeah, these novel, they are pretty much untested approaches, aren't they? Like negative interest rates.
Yeah.
How do we know when and if they'll work, or when and if they might be the wrong approach?
Well, I mean, there are several countries such as Sweden and Switzerland that have been doing this longer than Europe and Japan, but in the grand scheme of things, it's all very short term. We're talking several years here, and often these things can take quite a long time to play out. So it's all one big experiment at the moment. Yeah,
so do you take a sort of a corporate view on this? Do you have a view that, oh, well, they're sort of too untested?
Our view ultimately is that we for now will stay away from the banks in these sectors with large negative rates. It's really hurting their margin, and to the point where you have to question...
So, sorry, in Europe and Japan, you'll stay right away from those banks?
Yeah, we're staying away. I mean, it's just getting harder and harder for these banks to earn their way out of the difficulty that they've got themselves into. You know, they've built a balance sheet over the last decade in Europe, lending to corporates, which are now against assets are basically down, so property, for example. And it's for these banks to try and earn their way back, rebuild the balance sheet, essentially go through what Japan did in the 90s, try and get the banks to be back to good, healthy banks from being what are sort of largely zombie banks.
Gosh, that's such a, I mean, that's such a potent phrase to call them zombie banks. Which specific markets are you talking about? Just Japan?
I mean, I'd say Europe's in a worse state than Japan. I mean, Japan's been working this through now for over a decade, and Europe's really just getting into it.
All right, well, let's look at equities markets. I mean, in your view, what could happen with the US market? Could it go higher?
Yeah, a question we're really tussling with here is, can this stock market make it to new highs? Now, one of the roles as a fund manager is not to just necessarily predict what happens, but try and get an idea what the odds are, what does the market think, and then what do we think. And if there's a large difference in those odds, you can get quite interesting risk-reward. Now, I'll give you an example here. Merrill Lynch, our prime broker, they do a monthly survey. They speak to global fund managers and say, how much cash are you holding? And that gives you an idea of how bearish people are. Now, historically, this has ranged between, say, 3.5% and 5.5%. And right now, people are holding around about 5% cash. So that's nearly as bearish as they have been for the last decade, which gives you an insight into, do they think the stock market can make highs? And they're probably thinking no. So we're looking into things that say, you know, what can make this go higher from here, and do we think the market's possibly underpricing the chances?
Yeah, and so what's your conclusion?
Yeah, we think they are. I mean, let's take a look across several assets here. Bond market yields are lower year to date, which is supporting growth. Credit is cheaper year to date, so that means it's cheaper for corporates to refinance. Commodities are up year to date, which takes a lot of pressure off the energy and materials sector that were close to the brink there. And things like VIX, which is an implied interpretation of risks in the short term, is lower. So that's on your asset pricing side. You've also had the US dollar selling off on the back of a dovish Fed. And if you think that half of the earnings that the S&P companies make is from offshore, a weaker dollar basically translates straight into higher earning potential for for those companies. So you've got several strong factors there that are all better than where we started the year, that yet the S&P, the stock market in the US, is flat.
All right, and how do the continued terror bombings in Brussels, as we saw yesterday, but also Istanbul and Ankara in the last few weeks, how do they play into it?
I mean, these are terribly sad things on a personal level. Typically, they don't really sit in the market pricing for an extended period of time. You tend to get knee-jerk sell-offs, and then the market restabilizes because, largely speaking, they don't have too much impact on economies.
Well, in one way, that's good. I mean, a lot of people looking on would say, oh, well, that just shows how greedy they are. But in another way, that's a positive sign that the terrorists who want to disrupt Western ways of life haven't been able to do it to financial markets. But just what do you see looking across the fundamentals?
So looking across the sort of wider macro at the moment, we had the Fed push back last week on the hawkish rhetoric. That's good for stocks. We've got easing in China, very specific monetary easing. We've got some fiscal stimulus that's starting to come through. That's another big positive. So some of these wider level things are quite encouraging. Since mid-February, the data out of the US has surprised the market. It's tended to be over what expectations were. So that's another big plus there. So if you ask the question, is the US going into recession? It's one that the market's been trying to debate all year. PIMCO did a great piece. They're a big US bond fund manager. They estimate the probabilities around about 15–20%. Now, that's not immaterial, but it's still outside odds. So you got your fundamentals, you got your
And has that reduced?
No, that's high. I mean, it's higher than where it was 12 months ago.
Okay.
But if you recall, maybe 4 weeks ago, various market pundits were calling 30–50% chance of a recession this year.
All right. What about your fund positioning? Are you fully invested? Are you still in some cash?
We're fully invested. We've been fully invested for most of this bounce off of the lows in February. Now, that always raised a few eyebrows when we spoke to investors, but it turns out it's been the correct thing to do. We're getting into a level here where there's some congestion technically in terms of the price. It will be harder for it to punch through here, might take a few goes. So we're going to take some profits. But to circle back to our first debate, can the stock market make highs? If we see this market sell off, say, 3–5% from here, we're going to actually buy some call options. So that's a structure that will pay off if the market does make it to new highs in this half.
All right, Geoff Wood from Morphic Asset Management. We will leave it there. Thanks so much for joining us.
Thanks, Helen.